In today's video, we're going to cover the Mega Backdoor Roth. It's an advanced tax planning strategy that I discuss with all the clients at my wealth management firm, DocShah Financial. We help pre-retirees and retirees pay a lot less in tax than they otherwise need to. The slides that you're seeing are directly from my retirement planning course that I teach at Johns Hopkins University, which is also my alma mater. So without further ado, let's go ahead and jump into the Mega Backdoor Roth. And I'm going to look down at times too, because I'm going to be looking at some of the slides. So you might see my eyes bounce around a little bit. But the Mega Backdoor Roth is an advanced tax planning strategy that is essentially making after tax contributions to your 401k or your 403b or even 457 or TSP. All those four plans are kind of lumped together, but I'm going to focus on the 401k and the 403b for this video. So you're going to make an after tax contribution to this account, and then you're going to transfer it to either your Roth 401k, or if you have a 403b, it would be your Roth 403b, or even a Roth IRA. Essentially, what we are trying to do here is bypass the income limits of the Roth IRA. If you remember, the Roth IRA has income limit phase out. So as you start to make more and more money, you start to get phased out of being able to make the maximum contribution to a Roth IRA, which is $7,500 if you're under 50 years old in 2026. If you're over 50 years old, it's $8,600 because you get an $1,100 catch up. But as your income grows, the amount that you contribute becomes less and less and less until ultimately, when it gets too high, you are phased out completely from making any Roth IRA contributions. We'll put that on the screen too so that you can actually see what those limits are. So that's the idea behind the Mega Backdoor Roth. It is sort of the big brother of the Backdoor Roth, which, if you recall from our last video, is really just making after-tax contributions to your traditional IRA and moving it to your Roth IRA. So this is sort of the big brother, because in the 401k or the 403b, 457 TSP, these plans have much bigger contribution limits, and we'll talk about that in just a second. So essentially, you're able to transfer way more to your Roth IRA or your Roth 401k or your Roth 403b using the Mega Backdoor Roth instead of the Backdoor Roth. It's important to note not every plan allows this tax strategy, so you need to contact your HR department, but let's assume yours does, and I'll walk you through more details on the Mega Backdoor Roth. So we'll just cover the 4 steps required for the Mega Backdoor Roth. And again, this is something that I discuss with all clients at DocShah Financial, which is the wealth management practice that I own and manage. Now, the 4 steps here are: number 1, contribute after-tax money to your 401k or your 403b. Step 2 is check whether your plan allows an in-service rollover to either your traditional IRA or your Roth 401k or Roth 403b. If it does not, it doesn't mean that you can't do a Mega Backdoor Roth. You would just need to wait until your employment terminated. So you want to check if the in-service plan is allowed. Step 3 is then moving those after-tax contributions into the specific Roth account that you want to move it to. So Roth 401k, Roth 403b, or Roth IRA account. Step 4 is you're only going to pay tax on any earnings that accrue after those after-tax contributions were invested. So I'll talk about that now in the middle section, which is there's no IRS pro rata rule. Let's say that you have $10,000 in your traditional IRA, and you're going to do a backdoor Roth. So you're going to move some funds from your traditional IRA to your Roth IRA. And let's say you want to move $5,000 of those $10,000. Well, the IRS is going to come in and say, hey, half of that money in your traditional IRA is pre-tax. So if you're going to contribute $5,000 or any amount to your Roth IRA, half of that contribution is going to be tax-free and the other half is going to be taxable. That's the pro rata rule. So in that example, you have $10,000, half is tax-free, half is after-tax money. If you were to move $5,000 to your Roth IRA, you can't pick the $5,000 that is after tax and specifically move that to the Roth IRA. You're just moving the entire $5,000 as one pool of funds, and half of that is taxable and half of that is not, because that's the breakdown in your specific traditional IRA. Now, in the Mega Backdoor Roth, that pro rata rule doesn't apply because the accounts are actually separated. There's a bifurcation that takes place where you can actually choose to specifically move the after-tax funds to the Roth account that you want to go to. However, you also have to keep in mind that even if you make after-tax contributions, if they're invested and the earnings start going up, well, those earnings are pre-tax. They haven't been taxed yet. So ultimately, when you move money over, you could be subject to sort of an in-plan pro rata rule, separate from the IRS pro rata rule. So you can see there's a lot of nuance with this tax planning strategy, which is why it's very important to work with a qualified professional if this is something that you're considering. So now let's go through an example here on the right side of the screen. So let's say that you make $50,000 in after-tax contributions to your 401k. Those funds were invested, you generated a 10% return that year, so the $5,000 in gains has not been taxed yet. So when you ultimately move everything to your Roth IRA, you're going to have $50,000 of after-tax money that transfers, and along with that is going to be the $5,000 that has not been taxed yet. So that's kind of how that in-service pro rata rule applies. And that's the Mega Backdoor Roth in general. You're making those after-tax contributions to your 401k, 403b, and then you're going to transfer them to your Roth account, whichever one you designate, the Roth 401k, the Roth 403b, or the Roth IRA. And remember, when you have a 401k, you're moving it to a Roth 401k. When you have a 403b, you're moving it to a Roth 403b. So you're not transferring it from like a 401k to a Roth 403b. Okay, now I'll walk you through some of the actual contribution limits for your 401k and your 403b so that you have a better idea of the specifics of those accounts. So in 2026, your 401k limits are as follows. You have a base contribution if you're under 50 of $24,500. I'm reading right off the screen here. You have a catch-up contribution of $8,000 if you are over 50. You've also got a super catch-up if your age is 60 to 63 of $11,250. And the total limit between the employee and the employer, because remember, your employer a lot of times will actually match part of your contribution. The total limit is $72,000, excluding all of the different, various catch-ups that could apply. And you could be up to $83,250 if you include all the catch-ups. One other interesting note here for 2026 is that you have a Roth catch-up. So if you're under 50, so if you were 50 or older and earned more than $150,000 in the prior year, your catch-up contributions must be made on a Roth or an after-tax basis. Just a little nuance to keep in mind there. So as you can see, the Mega Backdoor Roth is a wonderful tax planning tool for high earners and even retirees or pre-retirees, because if you have planned ahead of time and you've built up those after-tax contributions, well then when you actually do the Mega Backdoor Roth, whether that's in retirement or pre-retirement, you can have really good tax implications depending on your specific situation. Again, it all depends on a million different things when we look at your overall financial plan. If you're interested in learning more about tax planning strategies and working with me, just shoot me an email, raul@DocShahFinancial.com. I'd love to hear from you in your personal situation. Otherwise, subscribe and I'll see you in the next video.